Welcome to Commercial Real Estate Pro Network CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Travis Watts. Travis is a full-time passive investor. He's been investing in real estate since 2009 in multifamily, single-family, and vacation rentals. Travis is the Director of Investor Relations at Ashcroft Capital, and Travis has invested in over 30 syndications. And in just a minute, we're going to speak with Travis about passive investing in real estate. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple of things you can do to help us out. You can subscribe, like, and share. And as always, we encourage you to consider leaving a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. And you can find us on YouTube at Commercial Real Estate Pro Network. And always, please consider subscribing. With that, I want to welcome my guest. Travis, welcome to CREPN Radio.
Hey, Darren, thanks so much.
Well, I'm looking forward to our conversation today. But before we get started, if you could take just a minute and share a little bit about your background.
Sure. And the first thing I want to say is please do go to YouTube and check out our very attractive guest, as you as you so diligently said. Okay. So sure. My background basically starts in single family. I got started in real estate the way a lot of folks do, and I bought a single family home. And from there, started kind of trying to scale that model. I did a lot of different things in the single family space. I did some fix and flips, vacation rentals, some house hacking, some buy and holds. And all the while, I was working an oil field job. So I was working 98 hours a week, 14-hour days. A lot of that was away from home, out of state, out of country. I worked in the Middle East. So it was crazy times. But what happened was the more properties I was acquiring, the more the light at the end of the tunnel was kind of closing in on me. And I didn't see this being a scalable model. I just felt like I'm going to max myself out at a certain point. And that certain point came in 2015. When I completely burned myself out and thought, okay, I love real estate. I love, cash flow, the tax advantages, the upside. Like I get it. It's tangible, touch it, feel it, see it. I just love real estate, but I do not love being in the business of real estate, managing tenants, trying to spend all my days off, finding properties, trying to compete with everybody out there. So what I discovered is there is a way to be completely passive in the space, and that would be through private placement investing or syndications, kind of the layman's terms. So in 2015 is when I started switching over to passive investing. And over the next several years, I had liquidated my entire single family portfolio. I had gone 100% on the syndication path. And today, I guess I call myself a full-time passive investor, with the irony that it's not completely passive because you have to still network. You still have to find deals. You still have to do your due diligence, right? So it's not like I'm just sitting out on the beach. But anyway, it's been revolutionary. I mean, for my wife and I, it allows us to travel, allows us a lot of freedom of lifestyle. And so what I do nowadays is I try to help educate in the space of passive investing to show folks this is a possibility, this is a real thing. And, everybody kind of has their why or their what. If you had enough money, if you had the financial, independence, what would you do with your time? And that's kind of my big message is something I call time freedom. And that's something that I believe passive investing can give folks. So that's kind of my background in a nutshell.
No, sounds like a full plate of investing experience. Starting off with one, and how many units did you grow to at your peak?
Yeah, that's a good question. So because I was doing all these different models, I constantly had turnover, right? Because some were flips and like the homes that I would buy to rehab that I lived in, I would only do that for 2 years. Then I would be selling them and then flipping them over. So I don't know. I probably got up to maybe like 8 or so at any given time. I don't know how many that I did in total, but yeah, there was a lot of work, a lot of turnover, a lot of changes. But at the time, through most of that period, I was just single with no kids. So I thought, why not, right?
Right. And were you self-managing all of these properties?
Yeah. So the first thing that happened when I started reaching out in desperacy before I was breaking down, how do I become passive? The first set of advice I got was, why don't you just hire a property manager, right? That'll solve all your problems. So at the end, I did have a property management company. But quite honestly, it didn't make it any more passive. I had to manage them. They had to manage the tenants. I still had to make all the decisions. What do you want to do with this? What do you want to do with that? The HVAC, the roof, whatever. So it didn't solve my problems, but I did try it.
And were you investing locally, or did you deploy a nationwide plan, or how were you?
Yeah,
What was
this
your
was all
strategy?
out in Colorado. I grew up in Fort Collins, Colorado, about an hour outside Denver north. And so I had properties all the way from Fort Collins into Denver. So that's about a 60-mile radius, give or take. And that's where everything was. And I started feeling also simultaneously, despite the passive and the active stuff, I started feeling pretty uncomfortable knowing how much of my net worth and equity I had in just single family in one small market, one small area, which granted, Colorado was booming. I mean, it was a great market. I mean, that certainly I attribute, that to a lot of the success that I had, but I knew that wouldn't last. I knew there's going to come a turning point, and I didn't want to just stick it all in one market and wait for that to happen. So part of the beauty of the syndications is investing nationwide, which I do now. I've got properties in probably, I don't know, 6, 7 states. So that's nice for diversification.
Yeah, I think diversification is key to any investment strategy.
Sure.
If you put all your money on red or Bitcoin or whatever, and turns out not to be the opportunity you thought, you
Yep.
could end up with nothing. So clearly not a good way to go. So you started off, did you say it was 2015? Did I get that right? When you
That was
started?
my transition year where I went from single family active to multifamily passive. Yeah. That was
Okay.
like the
So,
turning point.
so what was the year or when did you start investing?
2009 in September. So we were pretty near the bottom, but I get, everybody says, oh, you couldn't have timed that better. Well, in hindsight, yes. But I remember specifically at that time talking to family, should I buy a home, that kind of stuff. A lot of folks were saying no. They're saying absolutely not. The economy's in shambles. Like, this thing could go down further. You might be purchasing something that loses 30% more of its value. Everyone was scared. There was a ton of fear, at least in my bubble, my network. And but I took the plunge anyway because I was ready to get started. I had read years before this Robert Kiyosaki's Rich Dad Prophecy. So not Rich Dad Poor Dad, but Rich Dad Prophecy. All that book really taught me in high school, I think is when I read that, was don't be in the stock market. We're going to have this big stock market meltdown. That was his only like advice to anybody, because readers of him know he doesn't really give advice. So I didn't. So I had some money saved up for college. It was actually in stocks. I had pulled that out in about 2006, maybe. And I just sat in cash because I knew one day I wanted to do real estate. I didn't know when. And then here we were, 2009. It happened, so to speak. And the government was also giving out an $8,000 tax credit for first-time home buyers. So I'm sitting there running the numbers for myself thinking, well, wait a second, looking at this house that sold for 165, now it's 95. I got an $8,000 tax credit and I got the money for the down payment. I'm like, screw it. At the end of the day, I'll house hack it. I'll rent the spare bedroom. I did do that. That ended up paying my entire mortgage. And I thought, everyone's got their opinion, but the only one that matters is your own. That was my takeaway.
No, there's there's real wisdom in that. I think that it's especially in challenging times like we're in now. I'm more and more convinced that nobody knows what's going to happen.
Oh yeah, I agree.
We've not been here before. I think that everybody keeps trying to draw from past experience and paint a picture of this is where we're going next. But there's some compounding variables that I don't think that everybody fully understands, myself included. And uh, I think that the best thing you can do is assess as best you can, draw information from various points, test your ideas, and make sure you're getting into something conservatively, so that and not risking more than you can lose. I guess is
Right.
another good point.
Hmm.
But that aside, it's interesting your timing, the fact that you were able to recognize from a Kiyosaki book, which I'd not heard of, Rich Dad Prophecies. I've got to check that one out.
Yeah.
But that you had the idea to get out of the stock market in 2006. I mean, that was still things were running fast and up.
Yeah. Yeah.
Um, so uh, whatever your spidey sense was that encouraged you to get out. I mean, that sounds to me like you were paying attention or had some sort of a solid reason for getting out, and it certainly sounds like it paid well for you, so that you had the money to get into the real estate at the low time. I mean, that's the. I also wanted to just touch on another thing you said when you were asking friends, neighbors, family about investing
Hmm.
in 2009, and how everybody was saying, "Oh my God, no, 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 no," and how powerful. I mean, how difficult was it for you to go against the feedback you were getting?
Yeah, I think so. If we unwind a little further back in my life, I think there's kind of a lot of this trying to make a decision for myself, given my own, interest and my own goals. And so I've kind of done that a lot in my life, kind of so-called going against the grain. So I didn't make the mistake of asking about selling out of my stocks when I did, right? Because had I asked, it would have been absolutely not. That's crazy. What are you thinking, right? We're in the best bull market ever. But it and we got to be frank here. There was some dumb luck to it too, right? I mean, I'm attributing the fact that I read that book and I took that action, which I did. But who really knew? Like you said, the more you study and learn, it's like who really knows? Kiyosaki, by the way, also called for the biggest meltdown ever in 2016. Did that happen? I mean, so you might be right once, not twice. So he didn't have the crystal ball, and he didn't give a specific deadline either. He just said it's coming, right? Well, it just scared the crap out of me as a teenager. So I thought, well, if nothing else, I mean, what it can't hurt too bad to be in cash. Like it's not like I'm spending all my money, right? I'm just sitting on the sidelines. So it worked out, but anyway, my
No.
long-winded response.
Well, no, I applaud your action there, because I think so often it's the easiest thing to do is to sit on the sidelines and gather information and analyze and assess and try and pick your spot and not act. The
Hmm.
action is really the difficult. Uh, I mean, that's the test. Do you have the courage? Do you have the willingness to test what you believe, test what you know,
Yeah.
and
Yeah.
and go forward? And you know, I believe, and I would love to hear what your thoughts are on real estate.
Hmm.
But I would tend to think we're similarly wired as far as the thought process. Is that real estate it's not. I mean, while the meltdown of the 2008 could be, I think, probably more easily recognized if you, with some hindsight, just based on everything that was in play. Historically, it's been a pretty safe bet as with respects to housing, a
Hmm.
primary need. Um, it's not something that you can replace on the internet.
Yeah.
You can't go virtual. You can't. I mean, you may have technology. I mean, we're starting to see some things with COVID
Yeah.
uh, affect where people might live
Hmm. Sure.
and why they might choose to live in a certain place. But nonetheless, housing is just it's a basic need, and
Yeah.
as long as there's inflation and rent increases and valuations and interest rates, as long as interest rates stay in a and as long as interest rates stay competitive, and I
Yeah.
don't see how we can get out of this uh, based on raising interest rates, because that affects so much of the consumer's
Hmm.
willingness to spend money.
Right.
I think we're locked in these low interest rates
Yeah.
for a long time. But
Yeah.
I'd love to hear anything you have, any thoughts you have on just real estate, and then we'll
Yeah.
we'll get more into the passive side of things.
Sure. You mentioned something earlier, which was spot on. Like in 2015, I didn't just gamble and choose a shiny object and say, "Oh, multifamily, let's try that out." Like a lot of folks do with Bitcoin. I think that's what you mentioned earlier, right? And so everyone just wants to jump on the latest and the greatest, and maybe this is the next big trend or whatever. But instead, what I did is I knew my reasons for liking real estate. I already had a level of success there to an extent. And so what I did is I doubled down on the education aspect of real estate, and I started looking at what happened in 2008, 2009, 2010 in multifamily, what happened even before that. I started looking at a lot of data and default rates and, occupancy trends and all this kind of stuff. And then, because here's why, if I'm going to do all that work and all that education and really put everything I have into something, more or less, right? I want to make sure I can be in that ideally for 10, 20, 30, maybe even 40 years, and not be losing my ass every 10 years and starting over and trying to find the next latest and greatest. So there's a lot in what I invest in. There's a lot backing it, right? It's not foolproof. It's not recession proof. It's not a guarantee. It's none of those things. But value add properties that you're improving and probably buying at a discount from day one in the older sector, but not too old. So, like B class value add, 1980s, 1990s, early 2000s. I still really like that niche. It's very affordable for most Americans, but you're just above the subsidized housing. And we're not talking about Section 8. We're talking about the rent is $1,000 a month, So most families in America can afford that. And I feel like it's always kind of a sweet spot. You've got folks that move down from the luxury A class into B. You've got people always improving their lives, moving from C and D up to B, and a lot of people just staying put kind of in that so-called middle class standard. And so I really like B class value add multifamily. So that was my conclusion to the research that I conducted, and that's about 80% what I invest in.
So when you did your research, this is after you've already been in real estate, you're looking on where to go.
Right. When I was
Okay.
finally making that transition to passive around 2015. 2015 was like books, podcasts, mentors, research year. I went
Okay.
pretty crazy and overboard in 2015. So yeah, it was that year basically.
Okay. And and prior to that, you were investing in single family,
Mm-hmm.
doing some flips. You mentioned you had some vacation rentals.
Mm-hmm. Yeah.
Um, in all of that, can you sum up the, was there a frustration? Was it just the overwhelming? You mentioned about the light
Mm-hmm.
at the end of the tunnel was getting dark. What
Yeah.
were the things that were leading to that
Yeah.
which you saw?
Yeah. It was all about my time. It was all about my time commitment. So I posted this video the other day on, I forget, Instagram or LinkedIn, and it was this, yeah, comparing an example between what if you had a single family home that you self-managed, a rental property that gave you a 15% annualized return, just to throw out a simple number. And then you have a syndication and multifamily that's completely passive and hands-off that gives you a 10% return. Well, on the surface, you go, well, the single family is a better bet, right? That's a better investment. Why wouldn't I just get 15 instead of 10? But here's the way I look at that. I see that as both of these pay 10, but the single family home has a 5% premium that you pay yourself in your time to manage it. So if it's worth it to you, whatever that 5% equates to overall for the year, say it's, I don't know, a couple $1,000, is it worth a couple $1,000 of your time to be the asset manager, basically to go buy it and underwrite it and close it and sign the dotted line and to manage your tenants and to advertise and to, or whatever, hire a property manager and deal with that whole fiasco. So it's not that one's right or wrong. It's just realizing your time value and what that's worth. And to me, I didn't have the time, but my time was valued high on my days off because I spent almost all of my life at work in the oil industry. So I really, really valued those days off. And when I had to spend them driving neighborhoods or putting in 20 offers and getting nothing back, that kind of stuff, it was just so discouraging. It was my biggest pain point, is I felt like I was wasting my life away. So for me, that's what it was. And that's what I speak a lot to, is kind of the time value, and to factor that into your investing.
No, that's a point that I think a lot of people don't recognize. I know myself, when I first got in, I was basically happy that the rent added up to the mortgage, insurance, and taxes. I had no idea that there was additional expenses coming, like repairs or vacancies or turns or all that fun stuff. So no, that's all good. So you made the decision to get into or to get out of the single family and to get into the passive investment. I know one of the things that most people are aware of or think about with investing is the ability to do an exchange. As far as I know, when you go from something you own to something you're participating in as a passive investor, the 1031 exchange is not an option available to you. Is that true?
So from my understanding, which clearly not a 1031 expert here, but it can be possible. It needs to be a like kind, property, and there's different third party groups that can kind of walk you through the ins and outs of that if you're interested. I didn't do 1031s going from single family to multifamily. And the reason is what I discovered after talking to several people that were doing syndication investing is, number one, it's common when you're 1031ing into a new syndication with a new group, there's often a really high threshold that you have to hit. It might be $1 million minimum, 5 million minimum. Everyone's got kind of a threshold there. So A, that could be a barrier for you. Two, that group often won't offer a 1031 option on the back end of that deal to go into their next deal. So then you might kind of be left hanging again several years down the road. Now you got to figure it out on your own again and switch to another group where you have to pay those costs. You have to figure out the logistics behind it, yada, yada. And quite frankly, there aren't nearly as many deals in this private placement space as there are single family homes that you could potentially purchase as an investment property by a long shot. My fear personally is that I would do one 1031, then another, then maybe another. And now let's say I'm in my 40s, 50s. Well, now it's not going to work anymore for whatever reason. There's no deals that I like, or the market's changed, or something happened. Now I might be stuck with owing 200 grand in taxes or something. And so I never wanted that unexpected explosion to pop up later in life. And so I've never done a 1031 myself, but not to bash it. I know plenty that have, and my dad has, and it's all great. But for me, not a strategy that I do.
Well, and I think too, for somebody that was in relatively short amount of time, I mean, from 09 to 15, roughly 6 years,
yeah,
you haven't eaten up a lot of depreciation.
Right.
I think it's something where if you've held a property for 20 plus years, it becomes kind of more of a something you're more attuned to or more sensitive to.
Yeah.
But enough about
it's
that.
one of those things that I feel like once you get on that treadmill, don't get off.
Right.
Right. Die on that treadmill.
Yeah.
That's
the
strategy.
No, I mean, exactly, because if you maintain the flexibility where you pay the tax, you can port your money wherever you choose, whether it be into another syndication, a stock, or whatever. You've got maximum flexibility because you paid the tax. So, and that's something I think that there was a point. It took me a while to fully understand and recognize the why, because I had always been had kind of a long-term view of real estate, as
Mm-hmm.
opposed to the value add kind of thing where you get in, improve the value, and you make your profit on the sale.
Yeah.
And so it's just, I think it's just it's a line that people need to recognize the difference.
Mm-hmm.
And that's about the sum of that.
Yeah.
Um, so, okay. So you make the decision, you get into, I mean, you've made the decision that multifamily is the space you want to be in.
Mm-hmm.
So you're no longer driving for dollars. You're no longer spending all these hours making all these offers, getting no deals, kind of being frustrated.
Mm-hmm.
Um, how how did you underwrite the deal sponsor that you selected to invest with?
Yeah, that's an excellent question. And quite frankly, I had it backwards when I first got started in syndications, and I put way too much emphasis on the deal itself, the pro forma, the projected returns, the what ifs, the possibilities, the dreams. And I did not put near enough emphasis on the sponsorship team, the general partnership. And at the end of the day, obviously what I've learned here over the past few years is it's everything about the team. It's everything about the execution of the business plan. It's that team's track record, experience, and capability of executing what they say they're going to do. So how do you know? Well, you've got to ask some questions. You've got to look at some data. You've got to check out their past performance. I mean, there's things that you have to do proactively. So the hierarchy that I give it is the team and sponsor. The market, believe it or not, I say is second. The deal is last. And I'll give you an example of that. That hierarchy. My belief is 2 out of 3 should do pretty well for you overall. I worked with a sponsor that was quite frankly just no good in one deal, and they did everything wrong. They made every mistake you could make, but they bought a great deal, a great property in a great location, in a diversified job market, and a growing time in the market. I mean, the market was just stellar, right? And so the deal and the market were in place, but the sponsorship team was just horrid. But we ended up profitable and just about hitting our projected returns, believe it or not. And that was incredible because I was so scared. I thought these people are going to run this into the ground, and it didn't. So they're all important. But at the end of the day, I'd rather work with a very experienced, competent group doing just a mediocre deal, because they're going to make it happen. At least I've got a little more certainty around that. So you want to start with your criteria. To answer your question more specifically, I had to write down my criteria. I like value add B class multifamily in these particular states. Whatever. I like monthly distributions, monthly reporting. I like, great communication, good transparency, like whatever. I had a big list. And I still do, but I don't know what it was back then. But and then I went seeking groups doing that, and so that's how I initially got affiliated with Joe Fairless and with Ashcroft. Was a friend of a friend introduced me, and it was just after I had wrote down all of my criteria, and it turns out they do 100% of what I'm looking to do, and so it was just that alignment, and it's been a great partnership. So that's most important. You just want to get along with these folks, trust them, and know that that they can do it, that they can do what they say they're going to do.
No, I think there's a ton of value in what you just shared there, because I think that uh, investing by nature lends itself to returns, the expectation of returns,
Mm-hmm.
and more is better, right? Uh, but I think one of the things that's often overlooked is the risk to get more, and not fully understood.
Yeah.
Specifically, I think in cap rates, just as a an easy example, I think that most people would look for a higher cap return, not understanding that that cap rate pretty well predicts your ability to exit the investment.
Mm-hmm.
If you have a really high cap rate, okay, who's coming in behind you to buy that?
Yeah.
Uh,
Right.
whereas if it's a very low cap rate, that says that there's a lot of competition and a lot of people want that property
Yep.
and that market that you're in. So I think that there is kind of that, um, you know, I guess it's just more of an education, more of
Mm-hmm.
a full understanding of what the numbers represent, what your
Yeah.
goal is, and how achievable is that goal, so
Yes.
that
Right.
you can hit the number and still have your principal, not put your principal at risk, right?
Yep. Number one for me, preservation of capital. So,
Yeah, it's something that I think when you have nothing, I guess there's also the flip side of that. If you have nothing, all of this doesn't matter. But if you've
right.
accumulated something, it becomes much more of a concern. And it sounds like, I mean, clearly you've whether you say it was luck in 2006, you got out, you had some money, you put that to work for you in real estate, you grew that, you got frustrated, you got that out, and now you're putting it in picking these passive deals. Uh, I'm assuming that you've done well. I mean, even when you talked about the one operator that you were invested with, that didn't sound like they were good at what they did, but they got lucky on market and a property.
Mm-hmm.
Um, Everything's gone up for you. Fair enough. I mean,
With the exception, here's one thing I'll point out. I did at one point take my eye off the ball, so to speak. And I never want to have 100% of my portfolio in one asset class or with one group or in one investment or anything like that. So I allocate 20% of my overall portfolio to experimenting. I've done some self-storage, some ATM machine investing, some first lien notes, some distressed debt funds. I have a lot of stuff in there, and it's hit and miss. But I'll give you a story of where I really kind of screwed myself. I had every reason to be doing this multifamily stuff. I'd done my homework, done my research. Well, I'm in a lot of investment groups, but I'm in a pretty big one out in Colorado. And there was a presenter there doing this new fund of distressed debt. And a lot of people were investing with them, and they didn't have a huge track record. But I kind of let all my criteria fall to the side and go, well, I'll give it a shot. Put in way too much. And about a year and a half in, one of their partners in this fund, that was not the people I did my due diligence on, it was someone out on the East Coast doing their own little thing, but they were part of this fund, ended up being a fraud. And so we all lost like 35% initially right off the bat of our total investment. And then now it's trickled in to be probably closer to 50%. So I lost a lot of money, and that's the Bitcoin example. And it scares me to death when people reach out to me on social media and say, I'm a Bitcoin trader. Do you want to buy my program or whatever? And I ask them, what kind of returns are you getting? And they're like, oh, 300% a week. And I'm like, you got to understand your risk profile and you got to understand reality. So that was my hard lesson learned. So.
well, your lesson clearly cemented kind of what we've already talked about is your priority. Priority one is the sponsor, right?
Yeah, right.
If there's no credibility from the sponsor,
Right.
the rest of it is really up to the shifting sands or the blowing winds.
Mm-hmm.
And I think sadly, I say sadly, I think part of life is learning from experience. I
Mm-hmm.
know my parents used to always say, well, I could have told you, and I a lot of the lessons that I've learned that are so indelible are based on mistakes I've made.
Yeah.
So
Yeah.
I think it's good to note that mistakes are going to happen, and even in some of these best, most vetted cases, there are no guarantees.
Correct.
And even in this market we're in, where we've already talked about, nobody really knows how this is going to play out. There will
Mm-hmm.
be lessons that are learned from this experience, that we
Mm-hmm.
can carry forward and apply to the next one. But the next one will be different than this one. And so
Yes.
it's a constant try and, get the information, uh, make assumptions based on educated guesses, based on experience and others, and that's just a constant.
Yep.
Um, so it sounds to me like you're a fairly, would it be fair to say that you, I don't want to say a control freak, but you like control?
Actually, I would say a little bit of the opposite because I had no problem relinquishing control to do these passive deals. And I realized that what I was doing actively when I had full control wasn't that great. There was people all around me doing it better. So I would say that for the folks that really love to have control and they have to make decisions and they have to, whatever, that the syndication space may not be a great option, or you want to limit your exposure there because you really are at the discretion of other people to make decisions on your behalf. So I don't have a problem with finding a trustworthy individual that I personally believe in and trust and saying, you clearly can do this better than I can. Here's some money. And that's kind of my approach with it is I don't think I can do any better personally, nor do I really want to. And so it's a good match for me. So no, I would kind of say the other way with that.
Well, in maybe I misstated that. I guess what I was picking up on was the aggravation level that you were having in the beginning, and then even you mentioned some anxiety about the one investor that was not good at anything, and how that I can
Yeah.
see, like, oh my god,
Yeah. Yeah. Okay.
sky is falling. So, but no, I think to the flip side of that, uh, the fact that you are willing to turn your, invest with others, and even, the ones where you've had some experiences, some lessons learned,
Mm-hmm.
um, you have your criteria, and you've defined that. And I guess my question is, when you define that, how did you go about gathering the information, sorting that? What were you relying on, or how did you
Yeah.
come up with that? Were you reading books?
I'll share with you something, and for your listeners, that I've done for a long time. It's just kind of my own little strategy or philosophy here. So I don't like to listen to any one source and then say, that's the way it is. I agree 100%. I'm done listening. I'm done learning. That's how it is. I like to instead, I'll read a book, say a real estate book, and it says something about real estate. Always do this. Okay, cool. I'll take a note of that. I'll read another real estate book. And if I happen to see commonalities, two people say, absolutely do this. Okay, there's probably something to it. And I keep reading, but I'm an avid reader. I'm an avid educator. So, after I get to 2, 3, 4, 5 sources that are all kind of agreeing, like here's the general consensus, we all kind of think this, then I implement that into what I believe or what I think. And so the same goes for anything. So before COVID happened, I was going around nationwide to conferences, big multifamily and real estate networking events. And I'm talking with hundreds, if probably thousands of investors. And something I did initially not initially, right after initially, to start finding who I wanted to invest with is asking people, who do you invest with? What has your experience been? And as I started hearing certain names of certain groups pop up over and over and over, and I started picking up who are the key players here, who's really in this space. And that's who I ended up investing with in most cases. So anyway, that's kind of how I approach it, is finding multiple sources to say basically the same thing.
Well, it makes sense. You educate yourself, you get reinforcement, what's that old saying? If you hear hoofs, don't think zebras first. I mean, there's just kind of that,
Yeah.
you get the information, you keep uh, getting confirmation. Um, you can try and go all the other ways, but if all the tried and true is, you know, heading in this one direction, and it's proven, or the experience has been mostly positive, it'd be hard to argue otherwise.
Sure.
So Travis, let me ask you. So your experience, you basically you were active, you made the decision to go passive.
Yep.
Who do you think, or I guess if somebody listening
Yeah.
is currently trying to do it on their own
Mm-hmm.
and they are reaching the frustrations, what are some frustrations that you would encourage them to look for, at, and compare that to what your experience has been on the passive side?
Sure, sure. And I guess I'll start answering that with just this realization that happened that was totally unsuspected from my standpoint. When somebody first told me about syndications and what that is, I was pretty skeptical, to be honest with you. I didn't think that, I don't know. I just felt like, okay, if you're buying apartment communities, you're a billionaire, or you're, I don't know, there's got to be a catch. There's got to be something, right? And so, or these are real estate people who have been in this industry for 10, 20, 30, 40, 50 years doing real estate. And this is kind of where they've graduated to. Those were my first thoughts, right? So I can imagine there's some folks thinking something along those lines. What I discovered is when I got into the space and started networking with folks, the majority of people who invest like I do in limited partnerships as a passive investor are simply highly paid business professionals, athletes, doctors, dentists, lawyers, attorneys, folks like this, right? They have a career, they have a profession, they make good money at it. And rightfully so, they don't want to take their eye off the ball, right? They want to keep doing what they do for money. And then they need a place to park some capital. Maybe they don't want to put 100% of their capital into their 401k or into the stock market. So this gives an alternative to that. So that's one thing. The other thing is, and so those are the folks that love their careers and want to keep doing them and just need a place to park capital. The other side of the coin is more like myself, who's out there doing everything on my own, being active, grinding it out, working a career that I hated, working a lot of hours. Basically, I just wanted to leave that job. That was one of my biggest motivators. And when I realized that, you know, first of all, I've always been an avid saver. I was raised by two very frugal parents, right? So I've always had this like crazy over the top savings rate, 50% plus of my income kind of stuff. And so I was parking all of that into real estate. And one day I sat down, this is the first time I guess I had actually sat down and calculated more or less my net worth. I thought, okay, but I did it in a weird way. I said, if I sold everything, if I sold all my single family homes, if I sold the house I lived in, if I got rid of all this crap, I paid all the tax and the penalties and all this, what would I actually have left over, right? It was like my real raw net worth. And I said, okay, if I took that number and I put it to work passively with like a conservative cash flow amount, that would be my projection number, what would that amount to? Well, what I discovered was it was enough for me to leave that job. And there couldn't have been a bigger motivator at the time. And so that's really what prompted me initially to pull the switch. And it wasn't until later that I really started discovering this time freedom concept. And this, the first thing I did is I went to work for a brokerage firm. So I wanted to learn stocks, bonds, and mutual funds. And it was just literally self-interest. I could care less what my salary was. I wanted to learn. That was something I actually just wanted to do. And then I ended up not liking it. So I went to go work for syndication groups because as you know, I mean, that's where I was transitioning into that world. And I thought, what better education than to work from the inside of this and then be investing in it. So that's kind of how it evolved. And I thought, this is cool. I have an ability to pivot careers. I have the ability to work part-time or full-time. I have the ability to move. And that's the thing for people. This has nothing to do with me, by the way. I'm painting this picture to say that passive income, when your passive income exceeds your living expenses, that gives you this type of freedom to make these different moves or go to church more, be more charitable, spend more time with your family, travel the world, whatever it is for you. Everyone has their why, as we talked about earlier. But yeah, that's the purpose. That's the bigger picture here is that it doesn't make much difference for most people to have $200 a month passive income. That's not necessarily going to be life changing for most people. But when you have 5,000 a month or 6,000 a month, now it starts to be a little bit of a game changer. You can make a lot more, positive changes in your life in different areas.
No, I think that's a good way to kind of summarize the passive income. That's the goal, is to have more than your expenses add up to. So that's good. Hey, Travis, if we could, I'd like to shift gears here for a second.
Yeah.
By day, I'm an insurance broker, and as such, we do risk management with our clients.
Okay.
And there's a couple of strategies we employ. We look and see, first, are we able to avoid the risk? If that's not an option, we ask, can we minimize the risk? And when that's not an option, then we look to see if we can transfer the risk. And that's what an insurance policy is a risk transfer vehicle. And I like to ask my guests if they can take a look at their situation, both their business and their clients. You can apply it however you choose to frame the answer. But if you can consider what you consider to be if you can explain what you consider to be the biggest risk. And just for clarity, I'm not necessarily looking for an insurance related answer, but if you're willing, I'd like to ask you, Travis Watts, what is the biggest risk?
I would say the biggest risk in passive investing to me is partnering up with the wrong team. It can be disastrous, as we've talked about. But, if you can't execute a business plan, specifically if we're not talking about value add real estate, so say we're talking about new development, new construction, it can be a very bad scene. So I would say, aligning yourself with the right folks, picking the right partners, and doing your due diligence up front to mitigate those risks. And in the deal itself, you're looking for a sponsor or yourself, if you're doing your own deals, to be as conservative as you possibly can be. You mentioned earlier on the call cap rates, on real estate. So if you're buying something at a 5 cap, you should be, and you're hoping to sell it in 5 years, you'd like to see a higher cap rate down the road, right? Maybe you project to sell at a 6 cap. You're just being conservative in case the market softens, in case COVID ends up being A, B, C, or D. You're using your best judgment to mitigate risk that way. So those are kind of the two-part question, two-part answer.
Oh, that's good stuff. Travis, I can't say thanks enough for taking the time to talk today. But before we wrap up, where can the listeners go if they would like to learn more or connect with you?
Sure. Something that we didn't talk about as it pertains to that. I spend my weeks on these 15-minute, completely free, no sales pitch Q&A calls, because I do a lot of videos and blogs and podcasting, and a lot of folks have questions as it pertains to them specifically. So if you want to sign up for a free 15-minute call with me, literally free, no obligation, or I have a downloadable guide. It's called Understanding Real Estate Private Placements. It's about a 20-page downloadable guide. Both these are free, and you can get them at ashcroftcapital.com/connect with Travis. And whether you just want the call or the guide or both, that's where you can go. Additionally, I'm on Instagram, LinkedIn, Bigger Pockets, Facebook, all these things. The symbol is at Passive Investor Tips. And so I push a lot of content out there too. And, everything's free and just a resource to help others. So feel free to connect if I can help in any way, anybody listening.
Awesome. Travis, like I said, I've enjoyed it. Hope we can do it again sometime soon, and stay well.
Thank you for having me, Darren. I really appreciate it.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.